What's up, everyone? It's Jason Drobeck with Neo Home Loans coming to you guys again with a video about conventional mortgages. Conventional, also called conforming loans, are used on the majority of home purchases in the United States. So the point of this video is to go through some details, highlights, and characteristics of conventional loans so you can be better prepared to use that product once you start your home buying process. So I'm going to share my screen here and let's jump into some slides. And again, our purpose today is to talk about what is a conventional mortgage, which is also what we call a conforming loan amount. So again, conventional or conforming loans, these loans are sold back to Fannie Mae and Freddie Mac. These are private companies. However, at this point, they are called GSEs. That means government-sponsored entities. They did get into a little bit of trouble in 2008 with their book of business, and we had to bail them out as a country. Therefore, they are government-sponsored, however, still private companies. So again, these are different from government loans like an FHA, VA, or USDA, as those loans are truly government subsidized. Conventional loans have loan limits that are set by the FHFA, that's the Federal Housing Finance Authority, and that adjusts every year based off median home prices changing. Currently, the loan limits for 2023 are $726,000 and $726,200 nationally for every county in the United States. Now, in some areas of the country, we have higher than average median home prices, and these are called high cost areas. So if you live in a high cost area, for instance, I live in Park City, Utah, both Summit and Wasatch County out here in Utah have loan limits that you can use on a conventional loan, all the way up to $1,089,300. So you're getting almost another $300,000 of room for a conventional loan before you have to move towards a jumbo mortgage. And again, these are called high balance conventional loans. And again, as I mentioned at the beginning of this video, conventional loans account for about 75 to 80% of all the mortgages in the United States. So these are a really impactful product, and chances are it's what you'll be using when you do your own home purchase. Moving forward, down payment requirements for a conventional loan, you can do as little as 3% down if you're a first-time home buyer on a conventional loan, and it only has to be one applicant. So if there's a pair of applicants on a loan or multiple applicants, only one of those applicants has to be a first-time home buyer, and then you can take advantage of the 3% down program. Even if you're not a first-time home buyer, you can do as little as 5% down on a primary residence over and over and over again with a conventional loan. Conventional mortgages also service second and vacation homes. They will do those with as little as 10% down. They also service investment and rental properties, and for those, you'll need at least 15% down. And then those high balance conventional loans, again, those loan limits that are above $726,201 to about $1,089,000, those you cannot do 3% down on, even if you're a first-time home buyers. Those will always require at least 5% down. Moving forward, conventional loans do require mortgage insurance. Now, one of the big advantages to conventional loans is that mortgage insurance is not permanent. If you do an FHA loan with anything less than 10% down, that mortgage insurance, it never goes away. Okay, so that's what's really nice about a conventional mortgage. The mortgage insurance automatically drops off once you reach 78% loan to value, or basically once you have about 20% equity in the home. By the way, this normally takes about 8.5 years of normal payments to reach that level in your mortgage, and that's starting with just a 3% down payment. You could always accelerate that timeline by making additional principal payments, or you could also in the future, if you do significant remodeling or upgrades to the home, you could call for a new appraisal of the property and potentially drop that early as well. But there's actually 3 different types of conventional mortgage insurance, which is another advantage to a conventional mortgage, and you can get creative in how to deploy that. So the first and most common method of mortgage insurance is borrower paid. And that means it's part of your monthly mortgage payment. And that's what most people are used to. Okay, but there's actually 2 other ways to approach mortgage insurance. The second option is single premium mortgage insurance. And this means that you buy out the cost of that mortgage insurance up front. So you don't have any mortgage insurance as part of your monthly payment, but this usually increases your cash to closing. Or you could use a seller credit to help offset that premium as well. And then the third and final strategy on conventional mortgage insurance is called lender paid. But essentially you could take a higher than market interest rate and have your lender or your mortgage provider pay out that single premium mortgage insurance. So for instance, instead of taking maybe about a 6.5% market rate today, you could go up to maybe like 6.875 or 7%, have us buy out the mortgage insurance. And again, it's not part of your monthly mortgage payment going forward. So really creative and a multitude of different paths you can take with mortgage insurance on a conventional loan. Moving forward and talking about credit requirements, conventional loans will allow you to go all the way down to a credit score of 620. So you don't have to have perfect credit. However, conventional loans do have what are called loan level pricing adjustments. Those are also called LLPAs. And this means that the lower your credit score gets, the higher those loan level pricing adjustments are going to be added on. So again, conventional loans penalize you for having lower credit. The mortgage insurance will also get more expensive the worse your credit score gets, okay? And again, conversely, as your credit increases or gets better, conventional loan rates get better and the mortgage insurance gets cheaper. Generally, I would say on the credit side, conventional is going to look better in pricing once you're over a 720 credit score, and that's compared to an FHA loan. When you're below 720, very often the mortgage insurance is more expensive on a conventional loan versus FHA. Moving forward, I'm talking about loan terms on conventional loans. Conventional loans allow you to select anywhere from a 30 to a 20, 15, or 10-year terms. And then some lenders, like ourselves, will allow you to pick any term that you want. So if you want to do 28 years or 22 years to your mortgage, we can certainly accommodate that as well. Conventional loans also allow you to recast. And that means you can make a principal payment, a large principal payment. It usually needs to be $10,000 or more. And then you're able to re-amortize over the original term of the loan and the original interest rate of the loan without having to refinance. So for instance, let's say you started your loan at $300,000. You actually end up having another home that you were waiting to sell, and you come across another $100K after you sold that house. Well, instead of having to refinance and pay all the closing costs again to get to that lower payment, you could instead recast, take that $100,000, pay it against your $300,000 balance, and then ask your mortgage servicer to re-amortize your payment over the original term and interest rate. And again, big advantage to having to refinance and potentially change that interest rate higher, like in today's market. Conventional loans also have both fixed and ARM rates available. An ARM rate, as a reminder, means an adjustable rate mortgage. However, over the last year or so, since interest rates have trended up, fixed rates have actually looked better than ARMs most times than not. Moving on and talking about your debt to income ratio. Your debt to income ratio is your gross wages, okay, before taxes versus your obligations going out monthly, okay? And with excellent credit, again, usually in the 740 plus range, you can normally get approved on a conventional loan up to 50% of your gross income, okay? Now on cash out refinances, and if you have a little bit lower tiered credit potentially, a lot of times that debt to income ratio will get capped at 45% instead. Talking about assets a little bit on conventional loans, primary residence purchases, so if you're buying a home that you're going to live in, have no reserve requirements on a conventional loan. The only caveat to that would be unless you're closing on your home before the start of your position. So this happens very often for doctors and white collar jobs, and that they're a lot of times starting they're closing on their home before they start their position. So in that case, you may need reserves, but otherwise primary residence transactions do not require reserves, which means you don't have to show any post-closing liquidity or any money left over. Now, if you do a second home or investment properties, those typically will require reserves. The amount of reserves you need to show will depend on what our automated underwriting system spits out. but generally you can expect about 3 to 6 months of reserves being needed. That means having 3 to 6 months of the monthly mortgage payment left over after closing. Those amounts can come from a variety of sources, such as your current checking or savings accounts, brokerage accounts, or even retirement accounts as well. And then third piece on assets for conventional loans is that gift funds are acceptable for down payment, closing costs, and even the escrow account on both primary and second home purchases. Keep in mind, gift funds are not allowed when you're buying an investment property or a rental property. Talking about appraisals a little bit on conventional loans, conventional programs, again, have the easiest appraisal standards, unlike your government loans like FHA, which are much more rigorous. So very often, if you're a buyer going into making an offer to a seller, a conventional loan is going to be a little bit more attractive to that seller versus an FHA loan, because again, there's less likelihood that appraiser is going to call out repairs or safety and health items that may have been caught in an FHA loan. Conventional loans also have no limit on the amount of acreage to the property, as long as you can find other comparable sales. So this can often be a challenge in rural places where maybe you have 5, 10, 15 acres of land on your property. As long as we can find other homes with that similar acreage pattern, in terms of what we call comparable sales for the appraisal, we'll have no problem getting that loan approved. And the nice thing also about conventional loans is you can use any appraiser locally to perform the appraisal. Unlike, again, government loans, which need a specific FHA or VA designation in order to do that appraisal. So again, it's also easier to get a conventional appraisal accepted by an appraiser. Last, and finishing up here with a few more unique advantages of conventional loans. One of my favorite things about conventional loans is you can pair it with a second mortgage in order to increase your buying power. So for instance, we talked about in Summit and Wasatch County in Utah here, the maximum conventional loan limit is $1,089,000, okay? Past that, you could add a second mortgage, a home equity line of credit as it's called, in second position, merge those two together, still stick to maybe a 5 or 10% down payment. And now with adding those two loan amounts together, you can get to a purchase price of well into the $1.5, $1.6 million range, which again is really helpful out here in expensive areas like Park City. The other unique and really huge advantage to conventional loans is there's no buy-in to the loan program. When you use an FHA, VA, or even USDA loan, they all have upfront premiums to their mortgages, which means basically you're paying a fee to use the loan. And again, conventional loans do not have this. So again, that was our little presentation on conventional loans. I hope you found that useful. And if I can answer any specific questions about using a conventional loan on your home purchase, please don't hesitate to reach out. Talk to you later.